Welcome to the Step Up seminar series. Those of you who've been here before in some of the prior sessions, welcome back. Those of you who are new, we are thrilled to have you here for a discussion from practitioners to try and enhance your preparation in terms of the real world. My name is Lee Pinkowitz. I'm Associate Professor of Finance and the Associate Director for Student Engagement at the Center for Financial Markets and Policy, one of the co-sponsors of this. All these sessions are standalone, but Tim is actually, this is his second session. So Tim is going to give a very brief kind of review of what that was. Remember, these sessions are standalone, but we don't want you to feel as though, well, wait a second, if I wasn't here, I'm going to miss out. So we're not going to, don't worry about that. I am going to, since many of you are new, I'm going to turn it over to my colleague who is responsible for helping put this together with me, Tom Bianco. Maybe just a real quick intro of Tim for the people who haven't been here. Tom.
Thank you, Lee. Even though these are all standalone, Lee and I have worked with each of the presenters to just sort of get a mosaic of, and in this segment of 6 speakers, of how research is carried on Wall Street, both on the sell side and on the buy side. So, and Alexia Quadrani and Tim Nollen have worked very closely together for many years. Alexia gave a product line overview, and hers was more from 50,000 feet in terms of it. Tim is really, his 2 sessions are really meant to be the nuts and bolts of how you do research. And in doing the nuts and bolts, we wanted to make sure that you had a skill base around that. So last time Tim spoke, he talked about, looking at a stock and taking it from a macro standpoint, looking at it from a qualitative standpoint and a quantitative standpoint. This time around, he's going to do a continuation of that and talk to you about valuation and how you communicate all of your reports to the constituencies. There was also a request from people that heard him last time to talk a little bit deeper about how you develop a theme and how you stay with a theme as it evolves, and he's going to do that once again. So with that, Tim Nollen.
Great, thanks, Tom. Thanks, Lee. Welcome back, everybody. Or if you guys were not here last week, welcome. We are designing this to have some continuity. So if you missed last week, I do encourage you to go back and watch the replay, because I'm going to be carrying on where I left off last time. So what I'd like to cover today is, I'll do a very, very, very brief review of what we went through last week, literally 1 or 2 minutes. And that leads into the main, I think, one of the 2 main thrusts of the conversation today, which is going to be about valuation, basically how we do valuation on Wall Street. And then a separate section on basically presentation skills, like how do we come up with themes, how do we present to investor clients that we speak with, and a topic near and dear to my heart, which is how to write effectively. Brief rundown then of what we went through last week. Basically, we ran through what does an analyst do, what types of sell side and buy side firms are out there. I talked a bit about my sector coverage, which I've coined the term media tech, which was originally traditional media, but over the last several years has shifted much, much, much more to streaming media and to technology data-driven digital media. We ran through some of the main ways to understand, how to analyze an industry, which leads into how to analyze a stock. And there are cyclical factors, which, for example, in the advertising industry include, various economic indicators. And then you can understand how a stock trades versus the market based on cyclical patterns. And then there are structural factors. And just one example in the media landscape is, the cord cutting phenomenon, people dropping their pay TV subscriptions in favor of taking on streaming services, and what has happened to the valuations of the traditional media stocks as that has transpired. And then, qualitatively getting into more stock-specific understanding, there's a difference between understanding what makes a good company versus what makes a good stock, some of these factors, and what makes a good or bad stock versus a good or bad company. And there are just lots of factors involved. I won't review all the details here, but again, this is what we talked through last week. Then we talked about quantitatively how to understand, how to model a company and how important it is. Now, I wanted to pick up on a question that came up last week, which is about the coursework that you're doing in accounting and finance. I mean, it is utterly essential. It is absolutely basic. You cannot be an equity analyst if you don't understand the principles of accounting. And then you bring that forth into understanding. So where we left off last week was talking about how to model a company, how to forecast earnings, and there are various examples I gave. I used Omnicom as an example. I used Disney as an example, and I used, I think, the trade desk as an example as well. Various earnings lines and some things to discuss in terms of revenues down to earnings down to below the line items. So I'm not going to review all those now, but this is basically what we got to last week. Let me put it this way. You must learn how a DCF works. DCFs are wonderful orchestrations of all of the principles that you learn in accounting and finance, brought together into a nice, neat kind of a summary of how to understand the value of a stock. So you have to put your earnings forecast into that. You have to understand discount rates. You have to understand the beta, that can affect, the volatility of a stock. All of this goes in to a DCF analysis, and it is an essential understanding that is required to do this work. That said, there is only, I think, one stock that I use the DCF as the primary valuation metric for, and that is Netflix. And the reason for that is the other valuation methods to use for Netflix, I find, are not that illuminating, not that helpful. Now, all this said, when it comes time to updating our Netflix forecasts and valuation, we spend a lot of time in that DCF because there are a ton of moving parts in there, and it's actually kind of hard to get your hands around and continue to see the forest for the trees when all of these factors are moving. So it's easy to get lost. So we do spend quite a bit of time on that. A couple more words on DCFs before I get into comps. We do maintain DCFs for all of the stocks that we cover, and actually they can be quite revealing sometimes. Let me give you a couple of specific examples here.
Tim, how many stocks? Tom actually was for the people here. How many stocks do you cover? So is one of two, one of 20?
One out. Yeah. I covered 24, 26. I forget. Call it 25 stocks.
So it is very rare for you.
Which, by the way, 25 is becoming a more normal number on Wall Street. I mean, when I started off, it was more normal to cover like 10 or 12 stocks, and now we're spread that much thinner that we're required to cover more. But so, one out of the 25 or so. But I keep DCFs for all of the companies that I cover. I do update them quarterly. And a couple of examples I want to give you on where DCF does matter. And actually, in these very volatile trading markets, this is actually very interesting and very revealing. Two of the stocks that I cover, the Trade Desk, ticker TTD, and Roku, which I'm sure you know as consumers, have traded at very, very, very high comp multiples over the last few years, up until a couple of months ago when there's a big, tank in a lot of these high-tech growth stocks. Now, I've noticed for a long time that the DCF values that I carry for the Trade Desk and Roku are quite a ways below the comp implied multiples. And lo and behold, you look at your DCF more recently when these stocks have traded down. I think Roku is down something like 75% from its peak just a few months ago. Lo and behold, the DCF is actually about where the stocks are trading at right now. On the other side, another stock I talked about last week, Omnicom, relatively boring traditional ad agency holding company. On that stock, I've had a DCF value quite a ways above the implied multiples on that stock for some time. And lo and behold, Omnicom reported results yesterday or today, last night. Good results. Stock was up 13%, I think it was today. And I looked at my DCF, and lo and behold, the valuation is actually right about where the DCF is telling us it should be. So you can go years with the DCF implied value being far above or far below where the comps are telling you. And eventually they kind of do come back to what that DCF value is. Now, does that mean that should be your primary valuation metric? Maybe not primary, at least in my case. But let me give you one other example. A colleague of mine who covers switched his primary valuation methodology from EV to sales to DCF. And the reason he did that was he felt that there was too much disparity in the EV to sales multiples among his stocks. And he felt that earnings were becoming much more important in investors' minds rather than just sales, right? EV to sales being a primary metric for software stocks. So he said, you know what, I'm going to make the switch. I'm going to look more at earnings multiples, and I'm going to use DCF as my primary valuation methodology. So these things do move around. So I'm going to talk about some of the comp multiples that we use, and then I'll show you some examples. So what multiples to use really depend on what sector you're following and what subsector, and just the way the market looks at it. I mean, comps are there because that is simply how the market looks at things, and you might agree or disagree with it, but that is how it's done, and so that is how we look at things, and they vary among the different sectors we follow, even the various companies I follow. So for some of the more mature companies, like the ad agency groups or the TV network groups, PE or EBITDA, EV to EBITDA are common metrics. PE, I was kind of brought up always using PE as the primary methodology. And you can look at how these stocks have traded versus one another, how they have traded versus historical averages, how they trade versus the S&P 500. These can be your sort of benchmarks. EV to EBITDA is a nice proxy for cash flows. One metric I did not put on here because I don't use it is price to free cash flow ratio. But EV to EBITDA is kind of the inverse, kind of a nice proxy for that. And actually cable stocks like Comcast and Charter are commonly valued on EV to EBITDA or price to free cash flow. EV to sales, as I mentioned, is a very common metric amongst higher growth tech and software names. I never used to look at EV to sales until I started picking up coverage of stocks like the Trade Desk and Roku. It's also very helpful for companies with negative earnings, where an EV to EBITDA or PE metric is kind of useless. For very mature companies, and I do have a couple of these, we do look at dividend yields. When I lived in London and covered European stocks, I found that dividend yield was more often referred to there. I think the Europeans like their dividends. Income investors, the whole class of investors that require a dividend to be paid, and so they want to know what the dividend yield is. So, a couple of the companies that I follow, like WPP or Pearson, which you may know, the educational publisher, dividend yield is often referred to for those two. And then I guess lastly for me, some of the parts analysis, and I'm going to get to a couple more examples in another slide or two, but companies that have, a variety of businesses or hidden assets, or if you have a sense that the stock, the company might be a candidate for a breakup, a split out, an acquisition, some of the parts analyses can also be useful for them. This is a snippet from my comp sheet. This is already going back almost a year, actually. But I just wanted to emphasize to demonstrate some of the points on here. So this is what we refer to on a daily basis. And an investor might ask me, how do you, what's your relative valuation on stock A versus stock B? So here's our, the tickers, our ratings. We try to keep a variety of outperform, neutral, and underperform ratings. And then we keep some of the main numbers on here. I know it looks like a lot of information on a page, but I find it very, very helpful to see what are the sales numbers, what are the EBITDA numbers, what are the EPS numbers. And then here are the comps that we refer to here. EV to sales is not referred to for the agencies. It's not really referred to for the media and entertainment groups. And for this group of ad tech stocks, it is referred to, but look at the disparity among some of these here. Criteo is trading at 1.7 times. The Trade Desk is trading at 25.4 times. You can't really compare them one to the other. But it is very useful, quite illuminating to try to understand the reasons why. Why does the Trade Desk trade at 25 times versus Criteo at 2? In this case, it's because the Trade Desk has had a good track record of meeting guidance, beating expectations, raising guidance forecasts. They have very strong revenue growth and very high margins. And the combination of those two is somewhat unusual in the high tech or the high growth tech and software space. Criteo, by contrast, has gone through a very difficult transformation over the last few years. They lost a lot of revenue for a number of reasons based on Apple and Google changing some of their policies. And Criteo fell very badly out of favor. It is now starting to recover. It's looking better, but its growth and margins are not as high as the Trade Desk. But mainly, I think it's because it has fallen so out of favor that its multiples are just so much lower than the Trade Desk, which is much more better liked by investors. We look more at PE for the agencies. We look more at EV to EBITDA for the media and entertainment names. Sorry, I'm not circling correctly. But as you can see, there's a huge variety in here as well. Disney trades at a much higher multiple because of its streaming services, which I'll get to in a minute. AMC, Discovery, Fox, Lionsgate, Viacom, CBS, they're trading, I guess you could say, more in a relatively tighter range, but there's still quite a bit of variety amongst those. So this is where you really have to dig in more and understand each of the companies, understand if there's a sum of the parts worth doing, understand what the various drivers are. And then you see we've got dividend yields over here. Cash flow yields, I don't really look at those too often. Anyway, that's my comp sheet. Let me look at a couple of specifics. Are there any questions thus far?
Tim,
Is this all clear enough so far?
Quick question for you. Actually, came in from Tom, but how? Because you have to put when you are analyzing a company, you've got a price target, right? How do you take all of this information, DCF and multiples, and come up with a price target? And then do your clients actually ask like what details you have in your DCF model or which comps you've selected? So how do you take all of this and boil it down to here's the target price?
Yeah. Well, no, I almost never get questions on what goes into my DCF. Okay. It does happen, but rarely. I always get questions on what are my relative comps and how do I think about them. I don't have an example in here, but I'll give you another one. There's 4 stocks that I cover that are in the let's call it the mobile app advertising and video gaming space. I don't know if you guys would know these names, but Unity, which I mentioned last week, which is a gaming software platform and also has an ad tech business. AppLovin, which is a mobile game maker and has an ad tech business, and then Digital Turbine and Iron Source. The range of EV to sales on these guys is literally something like 5 times for AppLovin up to like 20 times for Unity. And Digital Turbine and Iron Source are somewhere in the middle. How do we come to a target on these? Well, part of it, to be honest, is if you like the growth prospects of the company, if you think it's got a lot of upside, the total available market has a lot of headroom on the ceiling, there's a acceleration in growth rates coming, all these sorts of factors. Sometimes a stock looks expensive, but it just looks like such a good growth story that you want to own it anyway. So that's kind of how we came to our target price on Unity, even though it was already trading at something like 25 times EV to sales. Because Unity is one of these builders of the metaverse. And so NVIDIA or Facebook, which is now called Meta, companies like this just have, exponential growth prospects. I don't know about Facebook anymore, but anyway, Unity has exponential growth prospects. And it's almost like, I don't know what the right EV to sales multiple is, part of me almost doesn't care because I know it's big and I can comp it against a whole range of, software as a service, SaaS software companies that trade at higher multiples. So I can say, well, this is how I can justify Unity at a 30 times target multiple, because a bunch of other stocks that are growing even faster, are trading at 50 times or whatever the number might be. So there's a little bit of that. There's a lot of that goes into setting a target price. But understanding the relative comp group is very important, and then the factors within that.
So two other things here, Alexi. First of all, for those of you who read the chat, so Alexi would like to know, are there any industries where residual income could be the best valuation solution? For those of you who don't know, residual income is very similar to sort of DCF. It's a much more academic type thing. Yeah. Alexi, I can actually answer the last part. Why don't they respect DCF? It's because they don't like academics. But actually, Tim could probably speak to that. But Ian also has a really, really good point about, is your preference for comps based on the cyclical nature of the stocks that you cover, right? Cyclical company cash flows tend to violate the assumptions for DCF. Ian, I'm not sure I agree with that last statement, but I see where you're going with it. So Tim, I guess really they're both asking industry questions. Is your preference sort of, unbiased is not the right word, shaped by the industry you are covering? And is it that if they were covering a different industry, it might be very different?
Yeah, for sure. Why do we choose EV to sales versus EV to EBITDA versus PE versus dividend yield as the valuation metric? Depends on, the maturity of the subsector. It depends on the growth prospects of a company within that subsector. Depends on how you compare one with the other. So, look, comps are very useful because, it is what the market is telling you what the stock is worth right now, and you can agree or disagree with that. You can say, look, I think this is too expensive because of reasons X, Y, Z. I think the multiple should be 10 times, not 12 times. Or conversely, like Unity, you can say, look, I know it's already trading at 25 times EV to sales, but it's going to grow so much faster, and we can't even model how fast it's going to grow. I think it just there's a very, very high multiple. Don't know if that answers the question directly, but there are lots of different ways to look at these, and it's true you do sort of modify your approach to suit your needs at times. That is true. If there's a criticism of comps, it is absolutely that. Look, you can sometimes get caught in a cycle here where you're comparing all the stocks to each other, right? And so what's the right metric? Back to my mobile ad tech example, AppLovin at 5 times or whatever it is, and Unity at 20 times, and these other two guys in the middle. Well, there are reasons why Unity is up there and AppLovin is down here. I guess the sum of the parts, actually, the mobile gaming comps that it trades in line with trade at much lower multiples, whereas the ad tech business that it runs trades at higher multiples. So we settle on a breakdown of the valuation, kind of based on the other two companies in that group, Digital Turbine and IronSource, which are kind of more, call it pure play ad tech names without the gaming component to them. And so we use that as kind of a basis for what's kind of like a benchmark EV to sales multiple we should be thinking about for this group. So if 20 is the high and 5 is the low, well, the other two guys are trading at 10 to 15. So we can kind of use that as a reference point. Did that answer the question, or was there more to it?
No, I think that was good. James, I'm going to type the financials in the chat, so I'll answer that. Go ahead, Tim. You're good.
All right. Kind of actually addressed some of these, but let me give you some more. I've addressed most of these already, actually. Let me go back up to another slide, because PE and EV to EBITDA. Sorry, I lost my head. PE and EV to EBITDA multiples can be very revealing if you look at historical levels. So last week I gave a slide up here showing this is the media network groups, AMC, Discovery, Viacom, Comcast. I guess you got those 4 on this chart right here. The average 10-year EV to EBITDA multiple is this black line here. The average 5-year is lower. The average 2-year is even lower. And you can see they've all basically gone downhill, right? So the the reference point has just steadily gone down over the years. Then you look at these guys within that and you sort of say, well, the group as a whole trades at an average of, I'm going to make this up, 8 times right now. Actually, it is 8 times. That's below the 10-year average, the 5-year average, right? Why is that? Why do we think it should be there? Or why do we think it might actually improve to get back up to a historical average? We actually made this argument just today in a note we published on Omnicom, which I just mentioned, which after 4 or 5 years of kind of, being a bit lost in the wilderness and the growth rate stalled and COVID hit and they had to take all these, all severance and all sorts of things. Omnicom reported today their results actually were kind of knockout, back up to double-digit growth in 2021, guiding to 5 to 6% top-line growth in 2022. That's a lot higher than people were expecting. It's a lot higher than it's been for the last 5 years. So I made the argument that, historically Omnicom is traded at about a 16 times PE multiple, 15 times PE multiple. Historically traded more in line with the S&P 500. It's still at a big discount to the S&P 500 right now. And we set our new target price actually at 14, getting much closer to that sort of 15 times historical average.
Tim, Guillermo has asked a really good question in the chat. And basically it's, how do you deal with investments in intangibles, for instance, R&D and intellectual property for software as a service companies? But we can think more generally. He's asking, do these expenses distort multiples? Now, Guillermo, I don't know if you were intending this, right? But this is because in the US, for those of you who don't know, in the US, R&D is fully expensed through the income statement, according to GAAP. And so it would seem to be short-lived, but R&D tends to be associated with a long-lived asset officially. Any idea of how do you deal with intangibles, or does it affect all the companies within your industry uniformly?
Not exactly sure how to answer this. When I think of intangibles, I think of, goodwill and intangibles, which is a number that we just basically hold on the.
So think of our R&D. Think of our R&D, right? So, for instance, you could do this. By the way, you can think about it advertising as well. I saw you had some companies in London. I don't know if they're under IFRS or GAAP accounting, right? But in the US, advertising and R&D get expensed through the income statement directly, right? And so, do you or do analysts try to make any adjustment for that?
Okay. It's an interesting question because a lot of my companies, most of the companies I follow, report adjusted earnings and adjusted EPS.
Okay.
R&D, you're right, is expensed normally. So I forecast R&D as a percentage of revenue or growth rate, or one of those two, and I don't really adjust for that. But when a company under U.S. GAAP reports its earnings, it's required to put very clearly at the top of its presentation revenue GAAP earnings, not adjusted earnings. First, you have to give GAAP numbers, then you focus on those. So one of those adjustments, we generally refer to EBITA or EBITDA, so earnings before D&A, or at least earnings before amortization of intangibles. So that's to compare companies on a more like-to-like basis. And then there are other adjustments that we often make, and they can run fairly long. Restructuring charges, that's a big debate, whether you should include or exclude restructuring charges. Whether it's severance or whether it's integration costs of an acquired business or whatever it may be. So I think maybe the best answer would be we try to, in most cases, I think in all cases, put in the GAAP numbers. So whatever the actual cost items are, R&D, whatever they are, put them in there. And then we adjust out for some things to make companies directly comparable one to another. For example, the US ad holding companies like Omnicom versus the Europeans like WPP. We do EBITA because that puts those two on a similar comparable
Mhm.
basis between US GAAP and IFRS metrics. Does that answer that?
No, absolutely, and I greatly appreciate it. Those of you who either have taken valuation or planning to take valuation, we talk about this. One of the things we talk about is what types of adjustments have to be made, and it comes from accounting issues, right? Just there are accounting rules, and McKinsey loves EBITDA, right? EBITDA is sort of those of you who've seen the McKinsey valuation book. That's their metric, right? So thank you, Tim. And great question, Guillermo.
Yeah, no, very, very good question. And there are times when we get all caught up and running around circles trying to figure these things out. In fact, I've got two companies that have reported earnings just this evening, Disney and then another ad tech company called LiveRamp. And just before we got this call, I'm down an associate right now, so I'm doing some of the dirty work myself these days. I'm trying to put LiveRamp's earnings, update into my model, my Q4 numbers. And I made the mistake, because I usually rely on my associates to put these numbers in, of just putting in the reported GAAP numbers into the cost lines. Then I realized, wait a minute, my earnings don't look the same as what they're saying it is, as the adjusted numbers that I typically refer to. I had to scroll all the way down the bottom of the press release, find the various tables that show the adjustment items, and use those rather than the reported numbers. So, I literally an hour ago was just getting lost in this myself. Let's see, what did I want to talk about here? PE, EBITDA, so I keep talking about those. Some of the parts is a very interesting and sometimes useful evaluation tool. And let me give you the example of Fox Corporation, so the TV network group. If you were to simply look at Fox's comp valuation, just find this here. Now, this is a year old, so it's not exactly up to date. But see how its PE is almost 20 times 2021 earnings a year ago. All right, versus AMC is only 11. Let's just look at those numbers, for example. 20 times versus 11 times. Why is that? Fox has a lot of assets, you could call hidden assets, that don't necessarily show up in the earnings, in the normal EBITDA. One of those is a tax shield that it was able to create when it sold a big chunk of its business to Disney about 3 years ago. Remember, Disney bought a number of Fox assets, 20th Century Fox film studio, and some networks and so forth. In shield. So if you just look at Fox's EV, EBITDA, or PE valuation, it's going to look high because the market is assigning a value to that tax shield, which does not actually show up clearly in the earnings multiples. In addition, Fox has some below the line assets. As part of the Disney sale, they kept their studio lot in Century City, which they rent out to Disney. The value of that lot, just because think of all the explosion in streaming content and production and so forth, and the location of that studio, valuation of that lot is at least, I think it's a earnings, but it is an asset that you should account for below the line. And then a third thing, which showed up today, Fox reported numbers this morning. Fox owns a stake in a UK listed betting business called Flutter. The value of that stake has collapsed, along with lots of other valuations in the last few. And that alone led to Fox recording, for GAAP purposes, an earnings loss compared to their day-to-day revenue and earnings. Their earnings were actually positive. So we had to go into our sum of the parts and basically update our valuation for that publicly listed Flutter asset, which ended up reducing the overall value of Fox on the sum of the parts basis. So I hope all that makes sense. It's more detail than you needed. But the point is, there are a lot of assets within Fox that don't necessarily appear in the revenue and earnings for this particular company. Time is moving on, and I want to make sure we get to the presentation stuff. So I'll get to the oral presentation, the pitching bit, after I address the writing. And the reason I want to do it that way is the nature of equity research, in my opinion, is you have to understand the industry, you have to understand the company, you have to know the numbers, which we just went through. You have to be able to write a report because that is your calling card. That's what people actually read first. In fact, you usually can't talk about the numbers, and you certainly can't talk about upgrading or downgrading the stock. Right. Then you go out and you pitch the stock. Okay. We've addressed this, I think, the last couple of sessions. You know, there are different types of reports that we write. There's a quarterly earnings note, which I'm buried in, this week and next week. I try to keep these to like just a one-page, very concise summary. Or there's a news reaction, announces an acquisition, or the CF flash notes here at Macquarie. Just a quick note. Got to be concise, to the point, get your point across quickly. Then we do what I call stock or industry notes, generally like a 2 or 5 page type of a note. It might be a 10-page note, focusing on a single issue. Could be, a theme that you're developing. The themes for me, for example, in the ad tech space is data privacy. Given all the regulations that have come around, given all these moves by Apple to restrict the IDFA, which has helped mobile marketers to date with their targeting. This is a big reason why Facebook has been struggling recently. Meta, I should say, has been struggling, is because Apple changed the terms of engagement. And so I write fairly often thematic notes that started off with a big report. This is the third bullet, a big, 60 or 80 page report that I did on addressable advertising, with privacy as an important theme within that. Over the last 3 years or so, I've just done a series of 2, 3, 4, 5, maybe 10 pages on this data privacy topic. You might also write on, a company theme, whatever it might be. And then you got the big, as one colleague of mine used to call them, phone book reports. I don't remember what a phone book used to be. Just a big doorstopper, a big fat report that goes into lots and lots of things. It's important, I think, to develop your writing style. Please do not underestimate the importance of writing. And I think I mentioned last time, and I'll say it again. In my opinion, use publications like the Economist, the Financial Times, the Wall Street Journal, the New York Times. Use them as sort of guides to writing style, a way of telling a story that appeals both to a beginner and to an expert. So if you can frame your idea and write it out in a way that the reader can understand, that is a more valuable skill than you might realize. You have to know who you are writing to. I'm going to talk about this in the presentation, the oral presentation as well, right? When I'm writing a research report, I kind of have 3 groups of audience members in mind. First and foremost, I suppose you have to say is the investor base that I'm writing to, right? Our institutional investor clients that are reading my research and paying for it. And they might be, long or short the stock. They might be hedge funds. They might be long only funds. They might be, whatever sort of approach they may be taking. I have to be aware that I'm writing for that primary audience. They are our clients. To get to that client base, though, I very much have in mind that I'm writing for my sales force, because typically what happens is you write a research report, you go on the morning call, which I'll talk about in a minute, and the sales force takes that information and they go out to the broader client base, and they get on the phone and they email and they market that report. So you have to say things in a clear, concise manner, that a salesperson who is, presenting all of your research person can go out. And by the way, it really helps, obviously, have a track record, but you build a track record by developing themes, by having concepts and ideas that you keep coming back to, and you can reiterate and say, look, Disney just reported numbers. Their streaming subscriber number beat expectations. As we told you, they're going to be expanding internationally over the next couple of years. And so there's a real opportunity for them to be adding subscribers, right? That's a theme. And that's something that actually just came through in Disney's numbers just now. That's not a difficult thing for a salesperson to pick up on. They can go out and pitch that as a core theme. And they'll say, look, our analyst is talking about this theme. He's done the work to try to figure out what the subscriber numbers should be, et cetera, et cetera. So the sales force is a very important kind of audience that you're writing to. And then don't forget, there's a much wider universe of people that can access your research. You're covering stocks, so you're writing on these companies. If you're going to be downgrading a stock, you want to be careful about how you say certain things, right? You want to be sure that you're covering all the basic facts, and you're presenting things in a way that the companies that you cover will, even if they might disagree with your view, will respect what you're writing and say, I understand what you're saying. That's very important. And then, of course, there's the press, and there's other industry folk that are doing your research too. This is business writing. This is not prose. One mistake that junior analysts often make when they come in is they start winding around and telling a story, and then they get to the conclusion. Okay, this is not prose. This is not poetry. Nobody has the time for that. If 3 minutes is all you got, actually, when you're reading research and you're a portfolio manager and analyst, and you have 30 brokers or more sending you research on 1,000 stocks on a daily basis, you might only have 3 seconds, never mind 3 minutes, to figure out if you want to read this research report. State the conclusion first, then provide supporting evidence. It's almost to the point where, every paragraph that you write, you learn this in grammar school, should have a main statement and then supporting evidence. Main statement and then supporting evidence. Use the active voice, don't use the passive voice. Be consistent in what you say. Again, if you're reinforcing a call that you made, especially if you were right, and you say, this is what we said a week ago, we thought Disney was going to report subs of X, they just reported subs of X. Be consistent and reinforce the view that you have. Succinctness is very important, and the quality, much more so than the quantity, I think is really what matters. And again, kind of a bit of advice. My style is, I treat this as an iterative process. I don't necessarily sometimes dive in and just start writing, and then the ideas come. That's in direct contrast to a colleague I had once who was amazing at just sitting there with his eyes closed, putting an outline together in his head, and then getting out and just writing the whole thing just like that. So you have your own style, have your own way of doing things. But I guess my point is, understand what that writing style is. Let me give you a couple examples of bad writing, okay? This drives me nuts. Hope you can read this. These are actual examples that my associate wrote on a recent note on Unity. Unity is at the cross-section media. I don't know what the hell that means. And more specifically, has positioned itself at the forefront. The second bit of the sentence is a little bit more real. This actually makes a bit more sense to me. I crossed out the first bit because I just wiped that out completely. I won't read the example, but look at the second case. What was it? 2 lines on this screen I crossed out, and I wrote into basically 10 words. Succinctness, conciseness matters. Please avoid what I call squishy words. I've given a few of them here. Synergies is a totally overutilized word. Totally overused word. I just threw another one into my own sentence. And going forward is another one. People are often about, on a going forward basis. What does that mean? Just say it will. Please be careful of not capitalizing common nouns. This drives me nuts. Anyway, I won't be too on that. Okay. The oral presentation, the stock pitch. 3 minutes, I would argue, is maybe a maximum time that you might actually have to make an impression. In the morning meeting, what we're doing is we published our note overnight. We come in the morning and we are making our pitch to the sales force that they're then going to go out with to the Macquarie is basically, 2 to 3 minutes is your presentation time. During that time, you need to really say your conclusion. You need to state, what stock are you, what is your rating on the stock, and why are you speaking on this stock. Make your point. Give some supporting evidence, maybe 3 points of supporting evidence. Talk about valuation. Talk about risks to your call where you might be wrong. And that's it. And what I've found in my early days as a senior analyst, when I started going in the call, I made the mistake probably of trying to ad-lib a little bit too much. I found that I need to actually write stuff out myself, and it might seem a little bit simplistic, but I sit there and read it. I just sit there in the morning meeting and I read my presentation. You have to bear in mind, you're probably going to be on a call with, I said 4 to 6, that was our standard. 6 was an ideal number of morning meeting speakers. By the time you're at the 4th or 5th speaker, the sales force is already maybe starting to tune out, right? So you really have to make your point clear. And whatever you think you're going to say, you have to probably, cut it down and make it even more clear. I found that what I usually do is I write something out that I want to say, and I literally say, okay, now I have to cut this in half, because that's really about the amount of time that I've got. So morning meeting presentation, think of it in terms of 2 to 3 minutes, and then you might have, another 2 to 3 minutes of questions from sales. We also have afternoon meetings or teach-in meetings, which can go longer. This could be, for example, initiation of a company that might just require more time to talk through, or digestion of a complex topic, whatever it may be. So those are the kinds of the 2 internal types of presentations that we do. I threw up an example here. I'm certainly not going to read all of this. I hope you can see it. This is something that I wrote up. This is actually a relatively long morning call pitch for me, but it's when we launched coverage on 6 stocks. And basically the point I want to make here is, why are we on the call? What are we doing? Why does this matter, right? What are we saying here? How do we look at these stocks? What makes our viewpoint different perhaps from others? And then talk about the financials. Then I just focused on 2 particular stocks that I was pushing. And so I just copied in here what we said on Unity. All right. So basically what it does, what the numbers look like, following on the themes from up here, and then target price. And here's a 30 times EV to sales multiple I was talking about before. This, like I said, is probably actually pretty long for a morning call pitch.
I would say, Tim, you've learned your lessons well, because that's a perfect, that is a perfect morning call for the commentary on the initiating coverage. And Tim,
Well, I have been doing this for 20 years by now, Tom.
Yes. But the other thing is, sort of telling people about the 1-pager that you write behind this that follows up and then gets printed out is,
Tim, what I'd like to, you mentioned this, but I'd like you to, I guess, address this or stress it, right? Which is the business writing, the bottom line up front, right? Do you find, because we find this with students, do you find that junior analysts want to tell you everything they did with their analysis before they get to their conclusion, right? In other words, is it the analysis? So the way you write should be completely the reverse of the way you do the analysis. Does that seem reasonable?
Yeah, that's a good way to put it. In fact, in Macquarie's Japan research division, they have a standard where the first heading, the first bullet of every note says conclusion. It says conclusion and the one-liner, and then everything else follows from that. But yes, you're right. In fact, going back to my point on how this can be an iterative process, and maybe like step back for a second and talk about like how we develop a theme and come to writing a stock report. I find, it's a bit like the scientific method, I suppose, right? Go back to your chemistry class in high school. You sort of state a hypothesis, and then you go test that hypothesis, and you see if it proves out or not. It's hard to say, it's hard to come pick up a company or industry having no idea about it. I mean, you probably have some preconceived notion about it, right? Or I'm like, okay, I'm going to pick up coverage of Unity, and I know they just went public and the stock's doubled since it IPO'd. Therefore, probably every analyst that covers it already has a buy rating on it, right? So I have a preconceived notion about that. But I need to therefore try to put that to the side and then get down to basics and build everything up from the bottom, which is basically what this whole slide presentation from last week and this week has been about, how to do that. I find my writing style tends to be the same. I find some basic information, I jump in, I start writing, and the themes start to come to life as I go. An initiation report should be typically, I would say, 30 pages, sometimes more, sometimes less. You don't just do that in a week. You can spend months doing this. This mobile or ad tech and gaming sector, these 6 stocks that I picked up in the end of August, I started doing the work heavily on that in about May. And I actually dropped most other things I was working on to get these 6 stocks under coverage out, because it was important to me for various reasons to get these out. And I pretty much, other than earnings, in July and August, this is pretty much what my team and I did for 3 or 4 months. That's pretty fast, actually. That's a pretty fast turnaround to do this. So what was the point of this? Developing a theme is not necessarily easy to do. It shouldn't come to you from the beginning. It should come to you as you work through it and you read more and you understand more and you talk with a company and you go through the financials and you start to write. The themes start to come to life. Few examples of themes, and it's really important to develop a theme and develop a voice, because that's what you'll be recognized for. I'd say what I've kind of tried to do over the last, my whole career really, but it's, I think, come to a head really in the ad tech sector coverage that I've built up over the last few years with a lot of companies that have just simply gone public in the last few years, is I've drawn upon 20 years of covering the advertising industry, 10 years of covering the media network industry, put those two together and said, all these new companies have come to market. How can I pull the best of my ad industry knowledge, the best of my media industry knowledge into explaining how advertising technology works and why we think it's a good growth sector and who these companies are and what they do and how they're different from one another and why we think, for the most part, these are good investments. So, that's one example of me actually developing ad tech as a theme. And I partly chose that as well as something to focus on, because it's a hard as hell sector to understand. And actually, there's not a lot of people that on the sell side that actually cover it. So I just identified a niche that I could sort of build out for myself and say, this is where I'm going to kind of plant my flag. Other themes that can be developed that I've developed over the years, perhaps a bit more obvious, Disney Plus with its pivot to, direct to consumer streaming. And now, as I said, Disney just reported results a couple hours ago and had surprisingly strong numbers, but maybe not so surprising if you say, well, they just launched in 3 countries, last quarter, three big countries that they hadn't been in before. And by the way, there's a new Star Wars series, and there was that Beatles show. So actually, that might attract subscribers. On the flip side, Netflix, as you might have seen a couple of weeks ago, totally bombed out because it's hard to believe I'm saying this, but they're a more mature company by now in the streaming space. Their US subscriber base may be more or less maxed out. And because there's so much competition, they have to invest heavily in content just as everyone else does. So they guided their margins down in 22, not up as everyone was expecting them. We unfortunately did not have a sell rating on Netflix. We did have a neutral rating, which we had downgraded from an outperform a couple of years ago when all the streaming wars got underway. So that, again, is kind of a continuation of a theme. Looking at my notes, what else I wanted to say? I think that
can I ask a question? Yep. Just in that space, right? Because when it started, right, they were just streaming platforms, but we are seeing massive, I don't necessarily know capital investment is the right way to phrase it, but massive investment in content, right? Like Amazon is producing their own things and Netflix is producing their own, and Disney has their own. How do you incorporate, what was originally sort of a platform to now trying to account for basically they've become media companies?
Yeah. It actually goes back to this last bullet here, which I decided to skip, but I'll actually get to now. Up until 3 years ago, Disney was a traditional media company, albeit arguably the best. Therefore, usually traded at the highest multiples in the group. But when Disney made the big strategic decision to go over the top and launch its own streaming services to compete head on with Netflix and to provide a counter to the declining base of pay TV subscribers and the falling advertising that it was seeing. Investors' perception of Disney changed and the valuation methodology on Disney changed. It used to be a PE or an EV to EBITDA based stock. It became an EV to sales and a sum of the parts based stock. I think this will show up here. There you go. Can you see this? This was a year ago, so the numbers are not all up to date.
If you could zoom in, it would be, or there you go. That'd be helpful. Yeah.
The basis. Can you see this? Okay.
A little bit. Yeah.
A little bit. Well, this is what you need to see. Let's look at EV to EBITDA. This is the group right here. 21 and 22 EV to EBITDA. This is the peer group. Disney is well above everybody else. On PE, even more so. 39 times PE versus the average of the group at 16, including Disney. No, I think actually Disney's excluded from that average. But the point is, Disney's trading at much higher traditional multiples than the peer group because people are valuing it in terms of its streaming service. So what we started doing on Disney about 2.5 years ago when they came out with this plan was we applied a sum of the parts to what we thought would be its streaming subscriber numbers and revenue versus its traditional media businesses. We took Netflix's EV to sales multiple and applied that to Disney's streaming revenue expectations, going out a few years and discounting back, and then applying these traditional PE and EBITDA multiples to the rest of the Disney business. If you do that, you can very easily justify a Disney target price of, at the time, I think we were $200 or so, $210.
So what you actually are suggesting, right, and I'm going to thank Tom for this prompt, right, but this is that strategic changes by companies could actually change the valuation methods that you use and the thematic, a thematic change or a strategy change can change the valuation method. Is that a fair assessment?
Yes. And that goes back to the correct answer to DCF versus comps being it depends, and which comps to use being it depends. Yes, they do change, and you have to be flexible to that. You have to recognize those changes. I mean, a time will come when all these streaming services get more mature, and we'll start to look more at their earnings. I mean, I would even argue it's not right, and I've argued this for a long time on Netflix, that it's not right to value it on subs or on EV to sales because the content costs are so damn high. And actually in Netflix's case, by the way, their operating margin guidance is much lower in 22 than it was before, but it's still going to be around 20%. I mean, that's a real company. This is not a loss-making company. And their free cash flows are going to swing finally positive next year, 22. So, I've started having this conversation with some investors. I think I mentioned my software colleague has switched his valuation methodology now. I've started having a conversation with investors. When do we start valuing Netflix on EV to EBITDA, not EV to sales or whatever's in your DCF? I think people are starting to do that. And maybe it's a little bit of impatience over loss-making companies that have now crashed in the last few months. Maybe it's an awareness that actually, believe it or not, earnings does matter. And so there comes a time when you have to look at that. So where EV to sales is the metric right now for the streaming guys and for the ad tech guys, that's going to change and earnings will matter. And then PE and EBITDA multiples will matter and DCFs will matter.
When you're using these comps, you had pointed out that in some of them, we'll call them outliers, right? How do you determine the comp set? Right. How do you, is there judgment of, well, this, I'm going to eliminate this as a comp because it's an outlier or I'm going to eliminate it for, I don't know, strategic reasons. Yeah. I recognize it's an art. So but how do you even think about that? And how should they be thinking about it?
Yep. Very important point as well. And you'll see, if you can see on the comp sheet here, in our media entertainment group, we exclude Disney and Warner Music from the averages here because they're so much higher. Warner is high for different reasons I won't get into. But Disney at 39 times versus the other guys at 8, 18. And by the way, Discovery and Viacom CBS are very much inflated here because this was right around the time. Might have even been the very same note where this happened. I mentioned this last week when Discovery had a huge run up for various non-fundamental reasons. And it hit these very, very high valuations. And then it just crashed almost overnight. Again, non-fundamental reasons, market trading reasons. So these numbers are, I think, at that time. And so they still have these much higher numbers. If I were to look at my comp sheet right now, in fact, I will, just from a couple of days ago, but on, let's say, EV to EBITDA, Disney before today was trading at 27 times. Sorry, that's PE, 27 times PE. The peer group average, excluding Disney and Warner, is 9 times. So the updated version of this comp sheet excludes Disney and Warner. And by the way, these numbers are much, much lower now. I don't know if I'm answering the question directly, but yes, there are. See, this is the downside to comps, is right. The downside to the DCF is that, you can always fiddle with whatever you put into it. The downside to comps is you can always fiddle with whatever you say that the comparisons are. And the timing and the reasons why you include or exclude whatever you want, right? But just to be clear, and believe me, we do this all the time, right? Integrity is so important, though, to the way you do things. I have been called out by investors for changing evaluation methodology, or, for example, raising or lowering the target multiple without perhaps giving a good enough reason. Like, we're raising estimates by X, therefore we're raising our target multiple by X, right? So you absolutely carry your integrity with you. And people are very, very aware. You might think you're just sending this stuff out into the Ethernet and no one really follows it or cares. We have systems at Macquarie that track readership of our documents. We can track emails that we send. I know who's reading my stuff. I actually know which of my investors are reading my stuff. And I can see who's reading it consistently. And I know, therefore, that when I get on the phone with them, they might ask me, okay, so why did you raise your target multiple on AppLovin? Why did you cut your multiple on Netflix? There's a lot of wiggle room in all this valuation stuff, but you have to be consistent and you have to have integrity in what you do, because you will be found out.
Tim, did you have a final sort of statement that you wanted to make here? Or?
It's a fascinating business. It's challenging. It's not always easy. In fact, it's usually not easy. But that's what's appealing to me about it, is trying to figure out what's going on in an industry, in a company, trying to figure out how to value it, trying to figure out how investors think about it, and what to do with your assessments. I love the writing. I love the investor engagement. It is a good job. It is a difficult job to get into, to be clear, as it might have once been, but it is still an essential component of the financial services industry. And if you're thinking about getting into research, it's a good way to think about things. And please do use your Georgetown connections, because as you can see, there are lots of them, and we are willing to help.
And I just want to remind everyone that next week we will have James Van Tassel from UBS and Tim Creedon, because we apparently need to have at least one Tim a week. So Tim will be coming in, Tim Creedon from Neuberger Berman, which will wrap up our first Step Up seminar series.